Hi there, I'm Daniel Lader, founder of Lader CPA and Associates, and welcome back to our Instagram Live series where we are talking about building a successful private practice from beginning to infinity. Knock knock, who's there? Audit. Audit who? Audit no better than to ignore my therapist and my accountant. All right, so this week we are going to be talking about maximizing deductions on your office equipment by using depreciation. Now, if you have never heard that term depreciation before, or if you have heard it but you don't know what it is, you are in the majority of the population, so don't worry about it. Let's talk a little bit about what that is. First off, depreciation is a tax tool that lets you deduct the cost of things like office equipment over time, because the IRS knows that your stuff isn't going to last forever. Now, this depreciation is an either or. Depending on your situation, you can either deduct the cost of your equipment when you buy it in that tax year, or it's using depreciation and being spread out over multiple tax years. It's not a both, it's an either or thing. So let's talk a little bit about why this matters for you. First off, instead of taking a big deduction in that year that you buy the item, depreciation lets you spread that out, unless you have strategies that you want to use to accelerate that depreciation and take more in the year you bought stuff. Usually people are really attracted to that. There are reasons and strategies for slowing depreciation down, and there's benefits to that too, but it's much less attractive than accelerating the depreciation and getting the biggest deduction you can get. But let's talk a little bit about what goes into that. First off, what is considered equipment for depreciation? What can be depreciated? Things like your laptops, your computers, your tablets, those are depreciable assets. Your chairs, your desks, your couches, those are depreciable assets as well. Printers, equipment, fax machines, copy machines, all of those items are depreciable assets, or we can call them capitalized or capital assets. So what that means is those items could potentially need to be reported and depreciated over a length of time. Now, if that sounds like a lot of work, it is. And luckily, someone at the IRS realized how much of a nightmare that would be if you had to account for and depreciate every $20 pillow you throw onto your couch. So there is a safe harbor, de minimis, if you will, for items that cost less than $2,500. So any item you buy individually that costs less than $2,500, you do not have to depreciate. You can expense it immediately on your tax return and in your books. So that saves a whole lot of nightmare for people. Not every pillow, not every small computer or simple printer has to be depreciated and tracked that way. Now, talk with your tax advisor or accountant. There are some rules to make sure you're following to take that de minimis safe harbor of $2,500. You don't want to do it incorrectly and miss out. So ask them and they'll help you get that done correctly. Now, as far as depreciation and how it's spread out and how it's done each year, let's talk about that now. First off, each item you buy has a predetermined life that its depreciation is spread over. Ask your tax advisor if you need help with it. But the IRS has provided a convenient table that basically gives everything a preset life. Most items are 5 years or 7 years, or sometimes 15 years, don't have 15 fingers, or 39 years. So those are the most common predetermined lives that you're going to see for your business. Now, how the depreciation is calculated, it's not just taking the cost, dividing it by 5 and taking 1/5 every year, or dividing by 7 and taking 1/7 every year. The IRS actually uses an accelerated method called MAKERS. Ask your tax accountant if you want to hear something that'll put you to sleep. But basically, instead of being equal portions over 5, 7, 15, or 39 years, forget I said 15 or 39, but instead of equal portions over 5 or 15 years or 7 years, it's accelerated, so you take more depreciation in the beginning years, and that slowly tapers down over the remaining years until the entire cost is depreciated. But I won't get into that any more than I already have. Now you're probably thinking, what? I just bought this $6,000, $7,000 item, and I don't want to have to wait 5 or 7 years to get the full benefit of that. Well, you're in luck, because there's a couple strategies out there that exist to help you take more or potentially all of that cost much sooner. So let's talk about the two main ones, the two big ones. You have first Section 179. Now this was a lot more popular several years ago, before the second strategy I'll tell you about kicked in. But Section 179 potentially allows you to deduct all 100% of the cost of any items you buy. There is a limit up to 1.2 something million once you're past those limits. So once you're past those limits, you can't use 179 anymore. But usually for smaller places, that's not even a question. Now it lets you take up to 100% of the cost of that property in the first year. Now the equipment needs to be purchased and placed in service. Remember that term, placed in service. But it needs to be placed in service in the year you plan to take Section 179. Okay, we'll talk a little bit more about what placed in service means later. But basically, you buy it, you put it in your business, and then you can use 179 to take more or all of the depreciation you can. Now, the second strategy for depreciation is called bonus depreciation. Recently, since 2017, bonus depreciation kind of took center stage. The tax law changed, allowed 100% bonus depreciation for several years. However, that's been tapering down since 2024. Right now for 2025, it's been tapering down since 2023. Right now for 2025, you are only allowed to take 40% of the cost instead of 100%. What that means is if you need to use bonus depreciation, you can take 40% of the cost of that purchase taken up front immediately as a deduction in the first year. Okay? Now this also applies to new and used things and equipment and furniture you buy. Still needs to be placed in service in the year. Again, I'll tell you a little bit more about placed in service in a minute. Now you might be asking, well, there's Section 179 and there's bonus depreciation. They both seem good, but Section 179 sounds more attractive. Well, talk with your tax advisor. There are issues with both of those that you need to be aware of and understand, because not every situation is great for Section 179. Not every situation is great for bonus depreciation. So talk with your tax advisor, have them help you understand what you've bought or how what you've bought can be depreciated and how that can be accelerated. They'll tell you. Now, I've been talking a little bit about placed in service and what that means. If you work it out, it's pretty clear what placed in service means. When equipment is placed in service in your business, that is the time that you can start things like depreciation, claiming the Section 179 or the bonus depreciation. It's not the car you bought 2 years ago to use personally, then decided now it's a business vehicle, and put it in your business. Yeah, you can do that. And there's things you can do to help with the depreciation, but placed in service is not 2 years ago when you bought it, when it was personal use. Placed in service is when it goes in the business. So keep that in mind. Pardon me. Buying equipment or furniture or something that you eventually plan to put into your business, but is not yet in your business, can't be depreciated. So remember that. Not when you buy it, when you place it in service. Now, why does this information help you? Well, it gives you more power to control your deductions for your business. You might have a business that has a really high net income that you want as many deductions as you can to reduce that. That makes sense. Then some of these depreciation strategies like the 179 or the bonus, they're great. Use them. But you might be in a position where your practice is just starting out, very, very low net income or even losses, and you don't need more deductions. At least you don't need giant deductions in the year you're in. You'd be happier if in future years you could use those same deductions. Well, in that case, don't use these depreciation accelerating strategies. Let them take the 5 or 7 years of slow deductions to help wipe out future net income. So that's what you want to think about. Do you want more now, or would more later be more helpful? Now, if you have any questions about these topics, again, you can ask your tax advisor. You can comment on the video below or DM me, and I'll answer your questions as I'm able to. Now, if you would like to schedule a 30-minute discovery call with me or my team, go ahead and DM me. We'll send you a link and we can schedule that free call to talk about your business and your potential strategies and what we can do to help you. Go ahead and follow and subscribe for future notifications on these kinds of events or the tax tips that we're giving out regularly, and visit our website, latercpa.com. I will see you on the next video, and have a great weekend, and keep helping others to help themselves. Bye.